It is anticipated that when a stock performs well, more buyers would purchase it and bulls will arrive and get even more bullish. However, what occurs when ardent supporters and bulls begin to sell their stock? Recently, Tesla shares were sold by Cathie Wood and her company, ARK Investment, in order to purchase shares of other businesses. Since Cathie Wood is selling some of her Tesla stock for the first time in a long time to purchase another stock, many are wondering if now is the right moment for owners to hang on to their shares. Hi everyone, happy to be back at Tesla tomorrow. Cathie Wood recently sold 139,642 shares of Tesla, which at the time of the sale were valued at around $26.84 million. Around 20,000 shares of the ARK Next Generation Internet ETF and 119,630 shares of the Woods Business ARK Investment were sold. ARK used this to pay $19.84 million for 3,2,557 shares of payment processor Block. Blocks were among the top 5 holdings of the Architects Generation Internet ETF, the ARK FinTech Innovation ETF, and the flagship ARK Innovation ETF, all of which were used to make the transaction. In addition, ARK Investment purchased shares in Teladoc and Coinbase after Wood's funds sold off a sizable portion of Tesla's stock. This selling raises questions. Why has Cathie Wood sold her Tesla shares since ARK funds had been purchasing the company's shares up until recently? Please click the like button if you enjoy this kind of content before we continue. Before the sales, make sure you subscribe to the channel and enable notifications to be informed about all that Tesla is up to. ARK added $12.6 million in Tesla stock on March 8 after loading up to 1.3 million shares in December and January. The Woods Fund had already purchased approximately $4.6 million worth of shares of the company. According to reports, Wood made his most recent purchases during Tesla's 12.2% decrease, which was the company's biggest one-day drop since September 2020. During the first trading session of the year in the United States, funds backed by ARK Investment purchased almost 176,000 shares of Tesla. The purchases coincided with a 12% decline in Tesla stock after the business, which had been promoting hefty incentives at the time, missed quarterly delivery projections. Since October 3, 2022, when it began its most recent purchasing spree, Wood's exchange-traded funds have acquired slightly more than 938,000 Tesla shares. According to some commentators, Cathie Wood sold Tesla shares since their value exceeded 14% of the fund's portfolio. Investment analyst Alexandra Miz states that if a company's shares exceed 10% of the portfolio of the corporation, ARK is no longer allowed to add more. Though this may have contributed to the Cathie Wood's firm's decision to sell its Tesla shares, it's crucial to remember that Ron Barron, a prominent Tesla bull, has almost 52% of his assets invested in the company through just one fund. Additionally, NDRS noted that while the number of shares cannot exceed 10, there are no regulations dictating when they must be reduced. Although she may have sold part of her shares, Cathie Wood is no longer bullish on Tesla stock and is most likely not what is known to be a very strong Tesla bull. This does not imply that Wood is suddenly pessimistic on Tesla. In fact, the stock analyst thinks that Tesla stock will provide investors with enormous returns in the future and projects that the price of the stock might reach as high as $4,680 by 2026. This came following her forecast that the stock price will reach $3,000 by 2025. Cathie Wood is an avid investor in the stock market, having produced millions of dollars for numerous clients with her flagship exchange transfer fund in the past. This year, it's continuously searching the board for the next great thing. What lofty goals does Tesla have? The CEO of ARK Investment, who believes that Tesla would be the major beneficiary of the AI revolution and autonomous driving, confirmed her belief in the company when she purchased shares of Tesla on the day of its largest decline in September 2020. The transition to autonomous vehicles is still in its early stages, and Tesla appears to be in the lead. According to Cathie Wood, 2022 to 2024 has been predicted to be the most promising year for sales of electric vehicles since new models will be introduced. It is projected that the market for electric vehicles would increase from $287.36 billion in 2021 to $1,318.22 billion in 2028, driven by the potential move to battery-powered cars, surpassing the pandemic cost decline in 2020, as well invest in ARK CF8, according to Tasha Keeney. Over the next 5 years, autonomous driving is anticipated to account for more than 60% of Tesla's value. Like ARK Investment, Cathie Wood is relying not just on Tesla's potential for self-driving cars, but also on the company's whole auto industry. Based only on electric vehicles, the company has set a $500 per share post-stock split price estimate for Tesla by 2026. A number of factors could lead to this outcome. Credit rating companies have recently raised Tesla's excellent rating. Tesla's credit score was raised to bar 3 by Moody's, which became the second credit rating agency to grant the company investment grade status. When deciding whether to upgrade, the company took into account Tesla's growing product line, which includes the Cybertruck that will go into early production later this year. In addition, consideration was given to Tesla's financial strategy, management's operational history, regional production facilities, increased emphasis on efficiency, and financial leverage. Moody's predicts that as Tesla continues to expand its global presence, it will continue to be one of the top producers of battery electric cars. The agency's expectations, which are reflected in the rating adjustments, are that Tesla will continue to be among the top producers of battery electric vehicles, with a growing global footprint and extremely high profitability. Moody's investment grade rating ever assigned to the carmaker. According to the rating agency, Tesla has surpassed its targets in a number of areas. The company continues to show market leadership in electric vehicles with great manufacturing efficiency that supports strong EBITDA margins and sustains positive free operational cash flow, according to the SPI, which has a more positive opinion of Tesla's credit profile. The company is confident that Tesla will continue to have low debt levels as it maintains a healthy market share, profitability, and liquidity in the face of a faltering economy and a more cutthroat competition for electric cars. Although the average investor and Tesla shareholders may not find this upgrading significant, Tesla is thrilled about it because ratings below investment grade might stop some significant money from funding the business. A common practice among several sizable funds is to abstain from investing in businesses with ratings lower than investment grade. Right now, Tesla might not require immediate debt funding, and the positive perception that comes with the rating upgrades could work to the automaker's advantage. The manufacturer of electric vehicles works in a capital-intensive sector and is now working on a number of exciting new initiatives, goods, and services. These modifications could be useful if Tesla decides to access the debt market at any point. Moody's upgrade has meaning in addition to being useful. A deeper pool of investors is usually drawn to companies that move up from junk to investment grade, and historically, among rating-sensitive investors, a high-grade credential from at least 2 agencies is sufficient to be formally designated a blue-chip credit. Here's one perspective on it. Many analysts and investors already saw Tesla as a blue-chip firm. Bloomberg data shows that the company received a $5 billion revolving credit line earlier this year, indicating that it is getting closer to investment-grade status. With its new rating and its first 5-year credit default swaps trading in line with high-grade borrowers, Tesla has minimal outstanding debt. Due to its constant innovation, Tesla is in a very contagious position. In October 2022, the auto manufacturer will activate its vision-based park assist feature with the release of a new software update. Tesla ceased to incorporate ultrasonic sensors into the Model 3 and Model Y automobiles. The purpose of these ultrasonic sensors was to detect objects at close range. In order to estimate distances and provide park assist functions without the added complexity of these additional ultrasonic sensors, Tesla stated at the time that it planned to transition to a fully vision-based parking system using the numerous cameras surrounding the car. In fact, Tesla delivered on this in less than 6 months, along with several other amazing updates. What distinguishes Tesla from other automakers, and how long until someone can match it? Do you currently believe that buying Tesla stock is a wise move? Please share your thoughts in the space provided below. If you'd like to learn more about Tesla's recent activities, click the following video to view it on your screen. Talk to you there.